Bring in show music, please.
Hi, I'm CNBC producer Katie Kramer. Today on Squawk Pod. The drama devouring Washington and Wall Street, the president versus the Fed chair.
I don't think anyone on the entire planet can make a case that the Fed should not be independent.
Are Jay Powell's days at the Federal Reserve so numbered that he'll be out before his term expires next year?
I already think that there's a shadow Fed.
We have a special interview with Kevin Warsh, the former Fed governor, one of two Kevins, possibly waiting in the wings to be the next central banker.
This isn't the first time you've heard me in the last decade say we need regime change at the Fed. It's not just about a person. It's about an approach to economics. It's about approach to what they're doing. And I'm troubled when I see them moving the goalposts.
At the Fed during the great financial crisis, Warsh wants lower rates now.
The inflation that has done huge harm to the American people. First, they blamed Vladimir Putin. It was because of the war. Then what did they do next? They blamed the pandemic. Supply chains, they would say.
Well, supply chain was legit.
When was the last Fed chair job interview so public?
The broad conduct of monetary policy has been broken for quite a long time.
Plus, Coke, it's the real thing with real sugar. And the long days and short nights in Congress.
Doesn't it look like a kabuki dance?
What's a kabuki dance look like? We use that all the time.
We
I
do.
have no idea.
It's Thursday, July 17th, 2025. Squawk Pod begins right now.
Stand Becky by in 3, 2, 1. Cue, please.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernen and Andrew Ross Sorkin. Anybody drink regular Coke?
You got to be crazy to drink regular.
You used to.
I would
Coke.
if I could. I would if I could.
I like Diet Coke better than Coke.
I love Diet Coke.
You run on. I don't
love Diet Coke.
like the
and I like my coffee.
You ever?
As you know.
I'm drinking Sprite Zero now, but.
That's good too.
Do you ever run on a treadmill? If you run, I don't run very fast, but in running is an operative term. If you get 140 calories burned off, it takes like a half hour.
You should not be drinking Coca-Cola.
That's like you can either drink a 12-ounce Coke or run for,
I'm with you.
It's empty calories.
Diet Coke.
You're crazy.
Coke Zero. Do it.
Well, no, I know.
If you're going to do it.
I know. But if I could, and if you ever feel like upset stomach,
yes,
like that,
very helpful.
Regular Coca-Cola is amazing. I don't know what is in it? Fructose?
It's like corn syrup, but I
think
think although the
now
recipe's
apparently
secret,
it'll be.
that's the expectation. But I thought in Mexico they made it with.
I
real
believe in Mexico
somewhere.
it tastes a little bit different.
You gotta love
maybe a little bit better.
You gotta love the president likes the Diet Coke.
Oh, they said real sugar in Mexico.
The Diet Coke.
Pure cane sugar?
I don't know if it's pure cane sugar. I just
No,
know.
he said yes.
The Diet Coke to wash down the Big Macs in the fries. I do that a lot. I do that. There's sometimes I've done that. Wait, give me those nachos, Diet Coke. Right.
But extra cheese.
Yeah.
Meantime, President Trump now denying that he has plans to fire Fed Chair Jay Powell a day after he asked a group of House Republicans if they thought he should proceed with that move. Here's what the president said yesterday about it all.
Completely ruling out the idea of firing Jerome Powell.
I don't rule out anything, but I think it's highly unlikely unless he has to leave for fraud. I mean, it's possible there's fraud involved with the $2.7 billion renovation.
Now, in that clip, President Trump was referring to an over-budget renovation of the Federal Reserve that has drawn criticism, but that many see as a pretext for President Trump ousting Powell. In a radio interview that aired later in the day, the president then said that he would love if Powell resigned, but acknowledged removing him would disrupt markets. Goldman Sachs CEO David Solomon, Bank of America CEO Brian Moynihan both weighed in on the Fed yesterday during interviews right here on CNBC.
I think central bank independence, Fed independence is very important, and it's something we should fight to preserve.
The stability of this country is actually necessary and important to the whole world. And I think a stable Fed and an independent Fed is key to that.
Fed Chair Powell has been getting some support from an unlikely source. That's Massachusetts Senator Elizabeth Warren.
I mean, I understand that the idea of firing Powell to get lower rates would make you question Fed independence, but I don't think anyone on the entire planet can make a case that the Fed should not be independent. Because it's the most obvious thing in the world that there are times when you need to take some tough medicine. And because we all lived through Paul Volcker and 21.5% prime rates when inflation was, we know that you can't just keep the good times rolling all the time, or you're going to get South American inflation. So I don't even know why. We call it news when someone says that they think the Fed should be independent.
It seems like the president is basically saying it should be.
That's what I said. But the idea that you get rid of someone because you want lower rates, and I'm not saying we shouldn't have lower rates. I'm not saying we should. Nobody knows.
Right.
And the Fed has a tough position. They really do. But when you're always waiting to see something before you do something, you're never going to be ahead of it. But there's. You know what I mean? You
can. But do you think that
if you had to choose right now, is inflation worse, or is the possibility of a slowing recession or of a slowing economy?
Inflation.
Which is worse? You think inflation?
Well, if it gets out of control,
right.
I mean that's.
But either one, if you wait till you know, then it's going to be hard to stem it in the early stages.
But do you think that the FOMC has some magical insight?
I wish they did. That you need someone real. That's why guys that know things that are going to happen are money managers. They're not working.
But money managers aren't always right.
No, they're not always right either. Yeah. But you could, if you knew, you could make a bet now. But I kind of think inflation. Now I'm thinking that.
But here's a different question.
It's not the main thing.
I still go back to the idea that. I think that the market's already seeing through the fact that Jay Powell is not running the Fed.
Oh, it's already a shadow.
Like that, I already think that there's a shadow Fed. And I think that these comments have already put the independence of the Fed, not in question, but sort of optically and just even psychologically how the market thinks about what's happening.
Yeah. I think the bad news is I think that the Fed is going to be much less likely to cut rates because it's going to look like they're caving.
Well, that's
pressure.
the other thing.
So
All of these things don't help.
I know. Well, we're three talking heads opining. We have Warsh coming on, so someone that might be in that chair someday. And we're going to talk to him. So we can talk to him a little bit better. And amid President Trump's criticism of Jay Powell, we're hearing from other Fed voices on the economy. New York Fed President John Williams said yesterday that monetary policy is in the right place now to allow central bankers to monitor things before doing anything, taking next steps. He also warned that trade and tariff impacts are only just now starting to impact the economy. Meanwhile, Atlanta Fed President Raphael Bostic saying he still supports holding interest rates steady, though Bostic is not a voter on rate policy this year.
Have all members voted? Have all members voted? Do any members wish to change their vote? On this vote, the yeas are 217, the nays are 212. The resolution is adopted.
And the House adopting a rule late last night to bring forward cryptocurrency legislation. That vote took more than 9 hours as Republican leadership worked to win over holdout members. Originally, I think there were 13 Republicans who had voted against it. So it was a bit of a heavy lift. It did set the record for the longest vote in modern history. A bill to establish federal guidelines around stablecoins is likely to be the first bill that's passed. The Senate has already approved that. Also set to come under consideration is a separate bill to create market structure rules for crypto products.
And the Senate voting early this morning to pass a package of spending cuts that's requested by President Trump. It cancels previously approved funding of about $9 billion for foreign aid and corporations for public broadcasting, which of course funds PBS, also NPR. The vote 51-48, and then followed by a 13-hour series of votes on amendments. Republican Susan Collins and Lisa Murkowski voted no on that bill. They'll now head back to the House, which narrowly passed it last month. It will need to be approved and signed by President Trump by the end of the day tomorrow for the proposed cuts to stand.
No one can cut anything, even Republicans. I mean, the margin was like 2 in the House, and barely did it here as well. The thing with where it takes 9 hours, do they know they're going to eventually? Do they get something?
Probably.
Maybe
it's either you get something or it's a huge amount of pressure that's brought to bear. Like, hey, you're the holdouts, and I'm going to
It looks like a kabuki dance. It doesn't look like a kabuki dance. So you wonder why people.
What's a kabuki dance look like?
We
use that all the time.
We do.
I have no idea.
I think it's the costumes that
like
are more.
A secret dance or something. Yes, no.
I know it's Japanese theater.
Yes,
but
I think
I don't know what it looks like.
It's different than the horizontal mambo. I know that. I'm sorry, I watched Shane Gillis and the ESPY Awards.
Was that in it?
No, but I figured, what the hell? Because he did, and every single thing he said, He goes, "Whoa, we talked about that. I knew it wouldn't work for it. And it was
yeah.
Yeah, exactly. But he's getting a lot of play on social media. Some people think he went too far. Other people thought it was funny. But he won. Check it out. You can see all these. You don't have to watch live, Andrew.
I'm thinking. I'm gonna leave you out there on that limb. I'd rather do the chicken dance.
Yeah. Okay.
I'm a little afraid.
But
I'll go
the
with chicken
kabuki,
dance.
can we see what that? I think it's costume.
I was looking at it. It was a big costumes, big.
A lot of pomp and circumstance.
A lot of pomp and circumstance.
But nothing. It doesn't accomplish anything. I guess that's sort of a kabuki dance.
Maybe that's the. I don't know.
But you looked it up.
I'm going to look it up too.
We'll talk about it later.
We'll have to figure a little bit more.
Maybe we can get some video.
President Trump says Coca-Cola will be updating its American ingredients list. That news coming in a Truth Social post from the president, who is a noted fan of Diet Coke. He said, "I've been speaking to Coca-Cola about using real cane sugar in Coke in the United States, and they have agreed to do so." He added, "It's just better." U.S. Coca-Cola is made with high fructose corn syrup, at least as best as we know. It is a secret recipe. Archer Daniels Midland is one of the biggest producers of that ingredient. The shares for Archer Daniels are down by about 5.7%, much lower in the pre-market. When asked later yesterday about the president's claim, Coke didn't explicitly say that it would make that switch to cane sugar. In a statement, the company said, "We appreciate President Trump's enthusiasm for our iconic Coca-Cola brand. More details on new innovative offerings within our Coca-Cola product range will be shared soon." So if you're reading through the corporate speak here, it sounds to me like, oh my gosh, he made public comments that we were making to him kind of privately with maybe something we're planning. I would almost wonder, based on that statement, if they're just going to do a different line of Coke that says pure cane sugar and keep the old stuff there too.
In fact, they go on to say that they're thinking about introducing something called New Coke, which you remember that?
Yes.
Like one of the
it was
greatest.
During the Cola Wars,
and it
with
tasted
Pepsi.
like
Pepsi.
Yeah. I mean the reversal on that was.
That
is that
was
like
really
30?
great.
Is that like 30 years ago?
No, it's like 40 years ago.
Like 40 years
Yeah,
ago.
but it was back in the 80s.
Huge hoopla.
Maybe 35
Huge
years ago.
campaign. And
Big campaign, they did it.
like,
but
why?
it's also been written up in business schools because they thought they were losing out to Pepsi. They wanted to catch the Pepsi generation was going on at that time. They wanted to capture the younger generation. It's also the fastest about face that you've just about ever seen.
Yeah.
Where this is a marketing stroke of genius, or actually corporate governance that is still studied to this day in Harvard and other places about how quickly they pulled it and said, never mind, we made a mistake, we're going back to the old stuff.
But here we are now with 10 different versions, like Coke Zero, and they kind of did introduce a bunch of new Cokes, but they just didn't.
But they didn't get rid of the old Coke.
But they didn't
makes a
get
big
rid
difference.
Yeah.
I would be shocked.
Oh, in fact, then they started calling it Coke Classic.
Coke Classic.
Yeah.
Coke Classic.
Exactly.
Cheese will be next.
Coming up next on Squawk Pod, the economist who may end up leading our central bank, Kevin Warsh. He's calling for regime change at the Federal Reserve, and he isn't pointing at Jerome Powell. He's pointing at the entire institution.
I think we could use a new idea, a new theory of inflation, so let me practice one for you.
Okay.
Inflation happens when the government prints too much, spends too much, and lives too well.
An extended conversation about inflation, policy, and America's economy is right after this. Welcome back to Squawk Pod from CNBC. We're diving right back into the conversation around the Federal Reserve in the U.S. A few questions. Can the president fire a Fed chairman? And whether he can or can't, does or doesn't, in May 2026, we will have a new one. Jerome Powell's current term at the central bank will end, and all indications point to a new candidate emerging, possibly someone we know. So, who will it be? And what's the approach to both monetary policy and staying independent of the administration? The highest profile candidates so far include Kevin Hassett, current director of the White House's National Economic Council, who you may know from our interviews over the years, including one just this Monday.
I think that we definitely need to rethink the way the Fed's acting. We 100% want independent monetary policy, but it sure looks like they need more congressional oversight on things like the way they build their buildings.
Another candidate, another Kevin. Kevin Warsh is coming up in conversation, like with billionaire Home Depot co-founder Ken Langone earlier this week about a possible Trump golden age. He said this.
He's acting presidential. I'm impressed with the people he's got around him. I had a nice chat with Kevin Warsh last week, and part of my positivity comes from my discussion with him.
By the way, you can hear our conversations with both Kevin Hassett and Ken Langone on Squawk Pod if you scroll to previous episodes right in your feed. Today, we hear from Kevin Warsh himself. He is a Fed veteran, a central bank governor during the financial crisis of 2008 and 2009. He also served as one of President George W. Bush's economic advisors and worked at Morgan Stanley in mergers and acquisitions. Wall Street is considering what either Kevin might do at the Fed, but change is certainly coming. The Wall Street Journal's chief economics reporter, Nick Timiraos, a bit of a Fed whisperer, joined our TV broadcast today.
We are going to have the most unusual Fed transition ever, since at least the Volcker one, because in 87, Volcker to Greenspan, in 06, when Bernanke came in, Yellen in 2014, Powell, they all pledged continuity with their predecessor. They said, I'm going to step into the shoes of my predecessor. I'm going to try to be the same Fed. And now we have people who are running for the job who are saying, I'm going to be completely different.
Let's get back to Joe, Becky, and Andrew with Kevin Warsh. Becky kicks things off.
Kevin, we are very glad to have you here with us this morning.
Becky, it's great to be with you. It's a slow, lazy summer day on a Thursday. I don't know what could possibly be on your mind.
By the way, we booked you before a lot of the blow-up that came yesterday with what was happening. But you are here, and you are somebody who has been mentioned on the short list for people who would be headed to the Fed. We've thought that for a long time. We've had people like Ken Langone, who was here earlier this week, talking about how he is a huge fan of yours. I just wonder what you're thinking right now, where you see things.
Well, I think Ken's a great man. He's an American hero. I came to know him when I started to work for Druckenmiller about 15 years ago. And I talk to him all the time, and I usually ask him what's going on in the real economy. Almost everything he touches turns to gold. And over the last 6 months, every month, he would just sound a little bit more positive about what was happening. And he told me something's happening out there that's different. And I said to him once, I might sound a little like Joe, I said, why aren't you more supportive of the president then? This is because of policy. And I think, listen, my sense is that this is, we're at the forefront. We're at a transformational moment in U.S. economic history. This is, as George Shultz told me before he passed, a hinge point in history. I think the president's language is this could be a golden age. And frankly, I think they all could be right. Good policies could advance this U.S. economy, what we call AI. In a couple of years, we'll just call business. And AI is going to make almost everything cost less. And the U.S. can be a big winner. That's my argument to Ken. I think Ken's now come on to the president's side.
That's what he said when he was here.
And it's a hugely exciting moment. If I were to step back for a minute, if I were the president, what I'd be worried about is a central bank that doesn't see any of that. A central bank that is stuck with models from 1978, governance from a prior period, and don't recognize we could be at the front end of a productivity boom. And if I were the president, I'd be worried that they might not see it. And they might think economic growth is somehow going to be inflationary. I think we were probably in the early innings of a structural decline in prices. Ken sees it on the front lines of real businesses. And I think if you look over the period of the next year or two, it's a pretty special moment.
We've been talking today about how far the Fed should forecast, how predictive they should be, if they should be dependent on data that's coming in. And there's one school of thought that says it would be better to have somebody who sees this and can anticipate in advance. That's what great money managers do. But great money managers don't always get it right either. We spoke earlier with Nick Timiraos, who made the point that, look, sometimes it's better to wait so that if there is a mistake, you can recalibrate much more quickly.
So I heard a little bit about that interview, and I heard Nick say something like, well, what we need is continuity. My goodness, I think that's the last thing that we need. The broad conduct of monetary policy has been broken for quite a long time. The central bank that sits there today is radically different than the central bank I joined in 2006. I don't think we need policy continuity that brought about the greatest mistake in macroeconomic policy in 45 years, that divided the country, that caused a surge in inflation. I don't think we need continuity when the central bank doesn't have credibility. Last September, Becky, as you'll recall, the Fed cut interest rates 100 basis points, 50 basis points before the election, 50 basis points after. inflation was 50% higher then than it is now. And what did the bond market do when they cut rates? Long rates went up 75 basis points. That's a credibility crisis. So listen, this isn't the first time you've heard me in the last decade say we need regime change at the Fed. It's not just about a person. It's about an approach to economics. It's about approach to what they're doing. And I'm troubled when I see them moving the goalposts. It is very puzzling to me, Becky, how you could think that we should do emergency rate cuts last September, and now all of a sudden you stand there like a hawk. That's not good for the institution. I don't think it's good for the economy to be changing the goalposts like that.
Let me ask you, as somebody who's been there before, how much power/influence the chair ultimately has if you're in a room with 11 other voting individuals who may not agree with that person. Historically, there's been sort of an alignment. Everybody's tried, I think, to come to a unanimity on most things. And whether you think that the Fed, I don't know if in history there have been times where there's been, complete and utter distinctions between views on the Fed and what it ultimately means.
So there have been exactly those times. Paul Volcker, when he came in, not only have 12 years of experience in government and 6 at the Fed, I've got some knowledge of Fed history. Paul Volcker came in and said, we don't need continuity, we need regime change. And it was that regime change that brought inflation back and reestablished the Fed as this beacon of credibility. But the president at the time put in some members under the Volcker team afterwards that forced what some thought would be a coup. It hasn't always been pretty. In fact, my own view, Andrew, is what the Fed needs is more robust discussion of ideas, less groupthink. I don't like it that everyone's following the same models. To give you just one simple example, the dominant models at the Fed, which might have been the best models there were in 1978, what do they think, Andrew? They think inflation comes if the economy runs too hot and workers get paid too much. That's not my view. I think we could use a new idea, a new theory of inflation, so let me practice one for you.
Okay.
Inflation happens when the government prints too much, spends too much, and lives too well. That theory that money has something to do with monetary policy, is nowhere in the central thinking at the Fed. I think if those ideas were imported into the discussion, we could have a good family fight about it.
You don't get to decide how much is spent. That's up to Congress, and the president has to sign off on those things. Would you support them? And I guess the biggest question, Kevin, is people are wondering, the next Fed chairman, is he going to be independent? Is he going to say, and I say he because right now the candidates that we're hearing are all men, is he going to be independent? Is he going to do what he thinks is right, despite what the White House may advise or think, what the administration thinks?
So in a word, yes. So I've strongly believed for 20 years, and history tells us that the independent operations in the conduct of monetary policy is essential. But that doesn't mean the Fed is independent in everything else it does. In fact, if I look at the track record of the Powell Fed over the last 6 or 7 years, they've tried to say, how dare you be critical of us? We're independent in everything. Well, that's nonsense. They wandered into climate change, a subject upon which they have no comparative advantage. With a change of this administration, they said, just kidding. They wandered into another political area of which they were never assigned, diversity, equity, and inclusion. They changed the remit that Congress gave them about whether they were in the business of full employment or full inclusive employment. This change in their definition in 2020 is one of the key reasons why we had the great mistake, the great inflation. And on spending, Becky, during the period of the last administration, what did they say to Congress? Spend, spend, spend. So like you, I think they should stay in their lane. But it's very strange to me that they're asymmetric. Spend a bunch of money when it's popular, and now if you get asked about spending constraint, what does the leadership at the Fed say? Oh no, that's not about us. You should establish what the rules of the road are and stick with it regardless of the administration. I think the Fed has done a very good job of blaming others for their mistakes. It's been very popular to blame the president because he's being so mean to them. Well, most of the Fed's mistakes are because of choices they've made. They've done a very good job in the business of politics. The inflation that has done huge harm to the American people. First, they blamed Vladimir Putin. It was because of the war. Then what did they do next? They blamed the pandemic. Supply chains, they would say.
Well, supply chain was legit for a lot of inflationary.
Well, it changed the level of prices because that's what happens in a market economy. But that's not what inflation is. Inflation is what happens to the Fed. The Fed is responsible for inflation. The Fed makes a choice about inflation, and the problem is the Fed has made that choice poorly. So they've got someone new to blame for all these mistakes, and a lot of their co-conspirators in the media seem to believe it. The new mistake is the reason why they're not doing the right thing on rates is because of the president and those tariffs.
Well,
he's being so mean to them.
I will say changing the goalposts.
That's not the cause of inflation. The Fed controls that.
The changing of the goalposts that you mentioned earlier, where the Fed cut 50 basis points right before the election, 50 basis points right after the election. What was different was we have a new president, a new administration, and the tariffs came in. And I think even you, back in January, in your op-ed piece for the Washington Post, pointed out that, look, the Fed's job is to make sure that the tariffs don't turn into an inflationary pressure.
I think that's right. I believe that. But here's what's happened. The Fed now says, well, we'll make a decision about interest rate cuts depending on whether prices of goods in the next month or two go up. Well, what that's really saying is they must be doubting their own inflation-fighting credibility. If they were a very credible central bank, they could say, we're looking past this one-off change in prices. And so their hesitancy to cut rates, I think, is actually quite a mark against them. It's as if they've lost some of the credibility. Truth is, in economics and inflation, bygones are not bygones, Becky. The specter of the miss they made on inflation, it is stuck with them. So one of the reasons why the president, I think, is right to be pushing the Fed publicly is we need regime change in the conduct of policy. And I hear from Andrew, I heard from another speaker that was on, well, will the new Fed chairman, regardless of who it is, will he have credibility because the president's being so mean and pushing them around? The credibility deficit lies with the incumbents that are at the Fed, in my view.
Well, let me ask you a related question then. So we saw yesterday David Solomon, we also saw Brian Moynihan came on, and they said, look, the independence of the Fed is critical. The market, the global investing community needs to believe that whoever's running the Fed and everybody involved in it is independent from the president. That's conceptually, do you agree with that idea? And then if that's true, and this is a sort of very interesting sort of behavioral science sort of experiment, to some degree, whoever gets this job is going to obviously be appointed by the president, so they're connected to them in some way. But at the same time, as Nick was saying, and maybe you'll disagree with Nick said that person needs to somehow demonstrate to the market that they're independent of the Fed, otherwise they won't have the credibility.
So I hate to agree with Nick, but I guess I have to agree on one small part here. The good news is I have a track record. I have a track record going back 20 years, including in the darkest days of the financial crisis at the Fed. The track record makes me understand who's really talented at the Fed and who do we need to elevate, and who is sort of holding on to 1978 models who we need to relegate. Credibility comes through tough times. In the 2008 financial crisis, books that you wrote about with all this outrage, I can't find anyone at the Fed who was more aggressive in trying to get to the bottom of that and pushing radical new things that you might even describe as dovish. In the 2020 pandemic came, there was a huge shutdown to the economy. A month before Chairman Powell and the group over there said, well, maybe we should be cutting rates, I spoke and wrote vociferously that the U.S. should be leading an international effort to cut rates. They were slow there. In 2018, Jay Powell and his band of brothers put out dots that they were going to continue to raise rates through a market meltdown. I said they were out of their minds. They ended up cutting. So I think experience does help. Experience means there are times to be dovish and times to be hawkish. I'll give you one example of a time to be hawkish. 2021, 2022, interest rates were zero. The Fed was buying $100 billion of assets every month. Payrolls were going up by 500,000. Congress was spending $5 trillion. And what did this group say? This group then said it's all transitory. So I don't know. There's a time for a bird to change his feathers, and it's with the times. It has nothing to do with who's president.
Anyone ever said just shut up, listen, and learn? That because I said that to myself before you started. But for anyone that's Kevin wants to cut rates now because he wants a job. I mean, you just put out a sort of a dissertation on what your feelings are. That totally, for me at least, you explained yourself fully. I don't know if you get the job, but after listening to that, I'm ready to at least say you should be seriously considered. That was a master class.
Well, listen, I appreciate it, but this isn't actually about one person. This isn't about getting a job. I mean, what I just harangued Andrew about, that might be the greatest hits. These have been my views since the beginning of time.
The classic thing, Kevin, is President Trump, whatever his reasons are, he wants to cut rates. It could be because he's a real estate guy. But somehow you two arrive at kind of the same conclusion, maybe from totally different places.
Yeah,
but if you're right, you're right.
I'll say two things about that. One is we created the second monetary instrument called quantitative easing in the darkest days of the 2008 financial crisis. It's a second monetary policy tool. When we created it, we had cut rates to zero, so we said we're going to start buying all these bonds and all these mortgages from Fannie and Freddie. Now, if you listen to the Powell Fed, they say, oh, that big balance sheet, that has nothing to do with monetary policy. The real reason why we can begin reform at the Fed with a rate cut, which is just a first step to regime change, is if you look outside this window, financial markets, financial conditions, they are hot. IPO markets are back. Credit spreads are narrow. SPACs are back. Financial conditions are very loose here. What about the real economy? It's the real economy I talked to Ken Langone about. We're near a housing recession. Real households, first-time home buyers, small businesses, they're having a hard time getting credit. So at the same time, what can we do? Take a little of this looseness out of financial markets by getting the Fed out of the fiscal business, out of the political business, shrink that, and then redeploy some of that liquidity to people that need it most in the real economy. I think the Fed has the balance wrong. A rate cut is the beginning of the process to get the balance right. A strong real economy is what we need, so this can be a golden age.
You know, I was thinking about what you said about AI and the productivity gains we're expected to see and why that is part of the reason. And it reminds me of the other side of the Fed's mandate, which is full employment. Do you worry that the productivity gains that we see in AI will lead to a much weaker jobs market? You look at Microsoft or any of these companies that are talking about how they can do a lot of this work with fewer people at this point.
Yeah, so the amazing thing about this revolution, I think, is it's coming very quickly. In that ways, it's a little different than the internet or cloud or even the combustion engine.
Yeah, far different than the Industrial Revolution.
So I'm very open-minded about the speed of the change here. But I'll say something else. I think humans are underrated. I think humans have this incredible adaptability. If you look at the things that we all call work, 50 years ago, they wouldn't have considered any of this real work. What will be real work in 10 or 20 years will be different. So if there's a thing that bothers me about this speed of the transition, it's not that the U.S. will fall behind. The U.S. is going to be at the forefront of this. The relative growth between the U.S. economy and the economies around the world will widen. The president is right. The U.S. will be a big winner. My own judgment is this will be America's century again because of these policies and because these technologies are born here. I think that's all true. But if you said to me, what's a lagging worry? Technology is moving up and to the right. The K-12 education system is moving down and to the right. We need to make sure that these tools can be plugged into the most talented young people, regardless of where they are, so that they can achieve great outcomes. And the educational system, I would say, is an Achilles heel. That's why the work that Secretary McMahon and others are doing are so essential.
If I agree with your point that quantitative easing has seen its time and its moment. If you shrink the balance sheet quickly and really push things back to where they were before all of this, there's still a question of what that means for credit availability and what that does to the economy in turn too. This is an experiment we're still trying to figure out how to get out of and what the impacts are.
Yeah, so I totally agree, Becky. If you did any of these things quickly, regime change in policy shouldn't be done overnight. Quantitative easing, all this Fed purchases, we did in a dark weekend when we were making things up.
And I would argue was very necessary at the time.
And so do I.
Yeah.
We had an exit plan in 2010 and 2011 that once I left the Fed, they sort of forgot about. So there needs to be an exit plan to get the Fed out of the fiscal business, to give powers back to Secretary Bessent and to the President and Congress on fiscal policy. But it can't be done in a rushed way. It has to be done deliberately. So I'll just make this up. We need a new Treasury-Fed accord like we did in 1951, after another period where we built up our nation's debt and we were stuck with a central bank that was working at cross purposes with the Treasury. That's the state of things now.
Well, let me ask you,
Fed and Treasury. So if we have a new accord,
Right.
then the Fed chair and the Treasury secretary can describe to markets plainly and with deliberation, this is our objective for the size of the Fed's balance sheet. The Treasury can say, this is our issuing calendar. And by the end of, let's say, this administration, we'll be at an equilibrium rate on the balance sheet so that markets will know what is coming. None of this should be rushed.
But that would not, just to follow up on this, that would not be working in conjunction with the administration. It would be working with Treasury on goals that the Fed, it thinks, are important to try and pursue, and how you would present that to the markets as such?
Well, it'd be in conjunction, but here's a distinction that my friends at the Fed don't make. What we talk about independence, this is the independence in the operations of monetary policy. QE and QT is part monetary and part fiscal, and it is there that we have to work in concert. The reason why I think the Fed is in such hot water isn't because of buildings and isn't because the president's mean. It's because they've wandered outside of their remit, and they dare to say anyone who criticizes them is criticizing independence. The Fed's a powerful institution, but it's a narrow institution, and when it decides to spread its wings, it intrudes on other parts of the Constitution, other parts of our government.
We got to take a break. We're going to come back with you in a minute.
Are you making me come back?
Yes,
we're making
but
you
here's
stay.
the tease. The tease is going to be, here's the question. How would you feel about Treasury Secretary Bessent being both the Treasury Secretary and the head of the Fed?
Is it
too late to walk off?
Don't answer the question.
He feels
We'll be back in a
about it. He
moment.
wants to be the
Well,
guy.
no, I know, but one of the things he's talking about is the accord.
Stick around. Will this potential candidate for Fed chair answer that question?
Credibility is the coin of the realm. If the same person is in both of those jobs, you're going to have a bit of a credibility deficit.
We'll be right back. You're listening to Squawk Pod.
Up and Andrew, Q.
Want to get back to Kevin Warsh with the question that we just asked, which was around this idea that, and you talked about an accord between the Treasury and the Fed, which raised it in my mind, this speculation just last week that potentially Secretary Bessent could also become the head of the Fed at the same time, and what that would portend.
So I don't know if I'm supposed to say this on air, but I love Scott. I think Scott's doing a great job. He and I have a similar pedigree. We both worked for the finest investor in the world in Stan Druckenmiller. So if you're going to try to goad me into say something bad about Scott, I simply can't
that's
do
not
it.
the intent
I think
at all.
he's doing a great job, and I think he's serving the president well.
The question is whether you think that the same individual, not whether it's Scott or somebody else, could do both of those jobs, and what that would mean to this whole independence concept, and how people will feel about this accord even idea in that context.
Well, it would make the accord easier if the same person was on both sides of it. But listen, I guess I'd describe it to you this way. When I was a kid and I went to the Fed 20 years ago as a governor, I went downtown to see Paul Volcker, who was the great man. I think I brought my autograph book. I was so excited to meet him. I was a child to become governor. I asked him these narrow questions about the Fed. And he said, Kevin, listen, I'll support you. I'll tell the Democrats that you're going to be fine. But the job of being chairman of the Fed is two things. It's one, you got to get interest rates about right. And two, he said, you got to make sure you look like you know what you're doing. My view is the group that's there, they're well-intended, I am sure. There's huge amounts of talent. They haven't had interest rates about right for a long time. And they don't really look, as they change goalposts, like they have control and a deep understanding of what's going on. Credibility is the coin of the realm. If the same person is in both of those jobs, you're going to have a bit of a credibility deficit, the kind of credibility deficit that the Powell Fed has right now. So what I'd rather have are two people that understand that we have one government, that interest rates are part of it. The Fed has operational independence for that narrow area, and we work together seamlessly because we are on the verge of this transformational moment. And these two people can be on the same team, even if one of them is independent interest rates.
The last really effective chairman of the Fed that we had was who?
So, God, you're asking me to pick which. I'll say this.
I'm just asking you to go back about 4 of them to get
All right, well, let me say this.
Greenspan?
I don't know if this is in my interest or against. Ben Bernanke in the darkest days of the financial crisis was brilliant. And here's the thing he did that I thought was impressive. He put the likes of me and Tim Geithner and Don Cohn in his room, and we disagreed then and now about everything. And he wanted to hear us fight it out, and then he would decide. So during the darkest days where we're making stuff up, he broadened the discussion instead of narrowed it. And here's another thing he did in the crisis period. He was humble about what we know. No silly dots and silly forecasts. No placing blame on other people. No, taking responsibility. And I know it's very common now to say the problem is the president's being so mean to these guys. Most of these Fed's problems are because of Fed mistakes. The Fed needs to stop defending their mistakes and vindicating their critics and get on the right track. I'm a Fed guy, Joe. Yeah. I think it can be fixed. It was a great institution. And to use a cliche, I think it could be great again.
You're going to stick with us for one more second? I'm sorry.
I need a letter from Becky addressed to Stan that says, Mr. Druckenmiller, I'm sorry Kevin is late for work today, but we didn't let him leave.
We're going to do that now.
He's watching. He's seeing the letter.
We'll wrap things up with Kevin Warsh. So just philosophically, so you like Bernanke in those dark days. I think Greenspan almost reached the level of demigod, but one person almost the Mount Rushmore of Fed chiefs was Paul Volcker, in your view?
Paul Volcker reestablished Fed credibility after it had been squandered after a bad period of economic policy and inflation in the 1970s. That needs to happen again. I need to just put in a final word for Alan Greenspan. Alan Greenspan was a deft and effective chairman who kept the Fed in its lane and didn't wander out of its lane. Part of the reason why he was successful, he knew the Fed was powerful, but it wasn't all powerful. And he worked with governments, regardless of who was in the White House, to make a stronger economy.
And as I said off camera, you don't like a lot of guidance. When Alan spoke, he said a lot, but you never know what the hell the guidance was anyway, because he was so good at being sort of
inscrutable.
Yeah. But that's the way a Fed
It's best when a leader of an organization doesn't reveal all the things they don't know.
Strategic ambiguity.
If you don't know, it's better not to look silly with a bunch of forecasts that will turn out to be true. Keep your cards a little close to your vest and make sure when you speak it matters, because I'll end with where we began. Fed credibility is everything. It's more important even than the printing press.
We got 20 seconds. Should the president fire Jay Powell?
You're going to send me off with that, Joe?
Do you think he will?
I'm not in the politics business. That's why I tried to stay to central banking. Okay. I think that regime change at the Fed will happen in due course.
In due course. Thank you.
Thanks,
Kevin
Joe.
Warsh. Okay.
Great to be with you.
Good to be with you.
And that is Squawk Pod for today. Thanks for listening. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin. Tune in weekday mornings on CNBC at 6 Eastern. Get the very best of our show when you follow Squawk Pod wherever you get your podcasts. And let us know what you think. You can follow us on X, rate or review Squawk Pod on Apple Podcasts, or hey, even leave a comment on YouTube. We love hearing from you. Have a great Thursday, and we'll meet you right back here tomorrow.
We are clear. Thanks, guys.